Tax savings come in two forms: deductions and credits. Deductions reduce the amount of your income that gets taxed. Credits reduce your tax bill dollar for dollar. On every return, you must choose either the standard deduction or itemized deductions, never both. If your itemized deductions don't exceed the standard deduction, take the standard. Separately, many valuable benefits don't depend on itemizing at all. Tax credits, the student loan interest deduction, HSA contributions, certain retirement contributions, and some education benefits can apply whether you itemize or not. The key is knowing which items require itemizing and which operate independently of that choice. Start with medical, because nothing ruins a year faster than an expensive diagnosis followed by a shrug at tax time. Medical and dental expenses can be itemized, but only the part that exceeds a percentage of your adjusted gross income counts. That threshold is your bouncer. Costs above it are the ones that get in. Add premiums you paid with after-tax dollars, unreimbursed doctor and hospital bills, prescriptions, certain travel for care, and approved long-term care premiums up to age-based limits. If an insurer reimbursed you later, you subtract that reimbursement from what you claimed. Two habits make this category worth real money: timing and bunching. If you can choose when to schedule elective procedures or prepay orthodontics, stack big bills into a single calendar year so you leap the threshold instead of nibbling at it for 3 years and clearing nothing. Medical isn't just about itemizing, though. Health savings accounts and flexible spending accounts live in a parallel universe where your standard versus itemized decision doesn't matter at all. An HSA is a triple treat. Contributions are pre-tax or deductible. The money grows tax-deferred, and withdrawals for qualified medical expenses are tax-free. If you're on a qualifying high-deductible plan, fill the HSA first. It's one of the rare places tax law lets you win 3 times. An FSA is simpler. Contribute pre-tax, spend during the year on eligible costs, and avoid income and payroll tax on that money. The catch is use it or lose it rules, so pick a realistic amount. And don't forget the premium tax credit if you buy insurance on a marketplace and your income falls in the subsidy window. That's a true credit that can cut monthly premiums or show up at filing time as cash against your bill. Now switch classrooms. Education can hand you refunds even if you don't itemize. 2 heavy hitters carry most of the load. The American Opportunity Credit targets the first 4 years of higher education with tuition and required course materials. It can be worth up to a generous maximum per eligible student, and a portion is refundable, meaning it can create a refund even if your tax drops to 0. The Lifetime Learning Credit is broader and calmer. Undergraduate, graduate, or skills courses qualify, but it's smaller and non-refundable, so it can reduce your tax to 0, but won't go below. You can't double dip the same student and the same expenses between credits. Choose the one that pays more. If you're not chasing credits, there's the student loan interest deduction, an above-the-line deduction up to a capped amount that lowers your taxable income even when you take the standard deduction. Watch the phase-outs. As income rises, many education perks shrink or vanish. That's why it pays to know your estimated income early. If you're on the edge, you might shift tuition payments across December and January to land the credit in the stronger year. There's also the quiet superpower: 529 plans. Contributions aren't deductible on your federal return, but many states toss in a deduction or credit. Growth is tax-deferred, and qualified withdrawals for tuition and other allowed costs are tax-free. Think of a 529 like a greenhouse. Money grows better under glass. If you're already in the saving phase, a front-load contribution can put more dollars to work sooner. If you're in the spending phase, keep receipts and align withdrawals tightly with qualified expenses so distributions stay clean. And if your kid earns a generous scholarship, you can withdraw that amount penalty-free. You'll still owe tax on the earnings portion, or change beneficiaries within the family without tax harm. Cue the trading floor lights. Investments are where small, boring decisions snowball into real money. Your capital gains tax bill listens to holding period and tax bracket. Long-term gains and qualified dividends often enjoy lower rates than ordinary income. If your taxable income sits in a low enough band, you can even realize gains at a 0% rate up to the threshold. Tax-free harvesting. That's not a loophole. It's the rule book. Just remember the calendar. Sell on 30 December, and it's this year's problem. Sell on 2nd of January, and you just bought 12 months of breathing. Losses aren't failures. They're tools. If you sell an investment for less than you paid, that capital loss first offsets your capital gains. Leftover loss can offset a limited amount of ordinary income each year, with any remainder carried forward. The idea isn't to churn. It's to avoid paying tax on phantom profits that evaporate a quarter later. Just mind the wash sale rules. Buy the same or substantially identical security within the 30-day window around your sale, and the loss gets disallowed and added to your new basis. If you want to stay invested, switch to a similar, but not substantially identical holding, or pass the baton to a spouse in a coordinated plan that respects both of your wash-sale clocks. Wrappers beat willpower. Assets inside retirement accounts and ISA-style shelters, or their local equivalents, grow without you reporting annual gains. In the U.S., traditional IRAs and 401ks generally give you an upfront deduction or pre-tax deferral. Roth accounts skip the upfront break and potentially deliver tax-free withdrawals later. The real benefit is not just rate arbitrage, it's compounding without friction. Add the saver's credit if your income qualifies and you contribute. Yes, a credit for doing the grown-up thing. And now your retirement deposit earns a bonus at tax time. Don't tip foreign governments by accident. Mutual funds and ETFs that invest abroad often withhold a bit of foreign tax from dividends. If your fund issues the right statements and you're eligible, you can often claim a foreign tax credit and get a dollar-for-dollar reduction of your U.S. tax on that same income, up to limits. It's the textbook case of a credit doing something a deduction can't. And because 2020's energy policy knitted itself into the tax code, know that qualifying home energy upgrades and residential clean energy gear can generate credits rather than deductions. Credits are the good cake. If you're replacing windows, heat pumps, or installing solar, check the current rules before the contractor starts so your invoice, equipment specs, and certification statements are audit ready. Slide over to the house with the nice porch, mortgages, and home benefits. The mortgage interest deduction lives in itemized territory. If you don't itemize, you don't use it. If you do, interest on qualifying acquisition debt up to the legal limits is deductible. Acquisition debt means money used to buy, build, or substantially improve the home that secures the loan. Refi cash you spent on a beach vacation doesn't count. The law cares about what the borrowed money did, not what your calendar says. Points paid for a primary home purchase can be deductible in the year you pay them if they meet the rules. On a refinance, points are usually amortized over the loan's life. Private mortgage insurance deductibility has flickered on and off over the years. Treat it as check current rules and keep the 1098 and closing statement handy. Property tax sits in itemized land too, capped along with state and local income or sales tax. If you're near the cap already, prepaying or deferring property tax won't help. If you're nowhere near itemizing, you ignore it and take the standard deduction, which is why some homeowners get no additional federal break for property tax at all. That's not a mistake. It's just how the math shakes out. Home offices are the wild card. Valuable when done right, radioactive when sloppy. If you're self-employed and use a space regularly and exclusively for business, you can deduct a simplified per square foot amount up to a cap, or allocate actual expenses like a grown-up, rent or mortgage interest, property tax, utilities, insurance, and repairs, divided between personal and business use. Keep photos, a sketch with measurements, and your calculation. If you're an employee, the federal break for unreimbursed employee expenses vanished in recent years, so the classic home office deduction doesn't apply to W-2 life unless your state offers its own path. Selling the house? The main home exclusion can keep a big chunk of gain off your tax return if you owned and lived in the home for 2 out of the last 5 years and meet the other conditions. That exclusion stacks beautifully with basis improvements you documented over the years. Those kitchen remodel receipts you saved weren't just nostalgia. They step up your cost and shrink the taxable gain. A word about proof, because credits and deductions love paperwork. Keep the 1098 from your lender and the closing disclosure for mortgage math. Save HSA and FSA contribution records and receipts for qualified reimbursements. File form-type statements for education credits and student loan interest. Keep bursar bills that show who paid what and when. Download 1099s for dividends, interest, and capital gains. Store brokerage lots and trade confirmations so basis is never a guess. Keep invoices and manufacturer certifications for energy-efficient improvements. Save property tax bills and proof of payment. Audit proof isn't about having every scrap ever. It's about having exactly the documents that show who, what, when, where, why, and how much, plus a note in plain English that ties them together. Deductions, credits, thresholds, phase-outs. This can feel like alphabet soup until you remember the emotional point. Your tax return is a story about your year. You got sick, you took care of it, and the law gives you relief above a threshold. You learn new skills, and the law pays you back for investing in your brain. You bought a home and paid to borrow. The law, sometimes, lets you deduct the cost of the money. You invested for the future, took real risk, and the law rewards waiting with lower rates or tax-sheltered growth. You contributed to retirement, and the government literally hands you a credit for acting like a responsible adult. The rules aren't trying to trip you. They're trying to steer you. You don't have to love them. You just have to use them. If you want practical loop you can run every December without breaking a sweat, it's this. Pull a draft of your year. Income, likely deductions, realized gains and losses. If you're close to an education credit threshold, nudge a spring tuition payment into December or January depending on which side pays better. If you're in a medical year, prepay or postpone elective costs to bunch them. If you're in the 0% long-term capital gains band, harvest gains up to the ceiling without crossing it and reset your basis. If you're holding losing positions you no longer believe in, realize the loss before 31st December, and replace with a not substantially identical holding to keep your strategy alive. If your HSA or FSA contributions are lagging your plan, top them up within the rules. If your contractor just installed qualifying energy gear, make sure you have the right certification statement before you lose the email. And if you suspect next year you'll finally itemize, store your receipts like a librarian so your future self gets paid for being organized.